Welcome back. The US Federal Reserve paused for the first time after it started its rate cutting cycle last year. The Fed funds rate now stands as before at 4.25 to 4.5. The FOMC statement sounded hawkish, especially when it referred to the labor market conditions as solid and inflation as somewhat elevated. So, where do rates and the US dollar go from here, and what does it mean for the Reserve Bank and for the rupee? I'm joined by Stephen Englander, the head of global macros for Standard Chartered Bank in the United States. And in a bit, Neeraj Gambhir of Axis Bank will also join in to parse the India impact. But first, Stephen, good evening to you, and thank you very much for staying up for us. It must be very late out there. First, what are the key takeaways for you from the FOMC statement? It says labor market conditions are solid. What did you make of that?
Yeah, the statement itself, I think, was more hawkish than last time. And both the comment on inflation, that it was stable above the target, and the comment on the labor market that it was solid and unemployment was low, it really, if you just took it by itself, you wouldn't think that they would ever cut. But I think Fed Chair Powell clearly sort of massage that message into something more dovish, and that's why the market is reacting positively.
Okay, I missed that. But how many cuts have you penciled in, or had you penciled in? Have you changed the number because of the statement and the conference?
We think the U.S. economy is weaker than it looks. We think that the data are going to deteriorate as the first half progresses. And so we still have 4 cuts. You can think of that as a maximum. But, given that the market is pricing somewhere between 1 or 2, anything that's 2 or more, I think, would be very dovish and dollar negative. So we do think that the inflation numbers will get better, and we think that the labor numbers will get worse within a couple of months, and that will precipitate more aggressive cutting by the Fed than the market is now pricing.
Okay. 4 cuts this year definitely makes you a serious minority. But what is the course of the US yields as you see it? We saw a high of 4.8. Are we, is that behind? What would be the range for the next quarter?
I think that yields are more likely to come down even from these levels, but probably not very much. I think the inflation numbers that we've had recently have looked very benign, so we've already reacted to that, and there was some risk premium that was priced into the market, and that's come out. But we could go closer to 430, I think, on the 10-year, maybe 440. But I think we're not going to see 3 again. And once we actually get to the period of time, likely in the second half, when stimulus hits, I think we'll be trading, well north of 4.5 again. So I think there will be a temporary period of lower yields, but it's not going to last.
See it going below 4.5. That's very important because that will shape what the Reserve Bank is thinking. What's the future course of the dollar index, you think? It went as high as 110 last month, but today it hasn't moved after the Fed statement. Inched up a bit. Stays at 107.8 for the last couple of days. What's the future course?
I think that ultimately the dollar will follow yields and come off. But again, we would characterize this as a correction. We don't think that we've seen the peak of the dollar, but we think we've seen local peaks, and that there's room for the dollar to drop, say 2, 3, maybe 4%. As the macro picture becomes, visibly more benign. But ultimately, we do think that the dollar is going to rebound, that they're really determined to stimulate the economy, and that's likely to renew dollar strength. But we think that's going to be a second half of 2025 story rather than a first half.
Okay, but that's still important. If you're seeing yields higher and the dollar index also higher, that definitely makes life difficult for EM central banks. Now, just a word on US inflation. given that Trump is serious about tariffs, though he has not announced anything, and has actually done deportation, so serious about immigration. How do you see inflation rising in the US?
Well, it does worry me about inflation going forward, but I don't think it's an immediate threat. I think, again, it'll take a while for tariffs to have an impact. It looks at best that they're going to implement them gradually for the most part. And, I think that for the next 2, 3, 4 months, the inflation picture is going to look much better. The second half could be a different story again, where inflation picks up again. But I think we're likely to go, down to 2.5 on core inflation in the first half of this year. So I think that the Fed and the market will take some comfort from it. But tariffs have a cost in terms of higher prices, and immigration has a cost, or less immigration. I think it will be harder to get people to staff certain kinds of jobs, but that would be a slow working inflation process. It doesn't mean that it's not for real, but it means that it's not immediate.
Not an immediate threat. Stephen Englander, I really appreciate you staying up for us this late. Thank you very much indeed for joining us. We've got the key things from the US in terms of Stephen expecting that the dollar will continue to remain strong and US yields don't go down much at all. I think around 4.5 is what he was expecting. Let me welcome Neeraj Gambhir, the Group Executive and Head of Global Markets for Axis Bank. Neeraj, thank you very much for finding time for us. Well, Fed has not moved. The Fed Watch tool seems to give the impression of at best 2 hikes, some think even less. Sorry, 2 cuts, some think even less. Do you think the Reserve Bank has much elbow room? What about February 7th itself?
So, Latha, my view is that Fed is on an extended hold. I think if you go through the Powell's, conference call yesterday, it's very clear that there is a lot of uncertainty that they're dealing with, and they have practically no clue as to which way these things are going to play out, right? So I do feel that Fed is going to wait and watch for policies to be announced, study the effect of those policies on the inflation, growth, and various other parameters before they start making their mind about whether the next step is a cut or stay on hold, or maybe a very low probability event of a hike if the inflation doesn't behave well in US. Given that background, I think there is no real pressure from a global monetary policy cycle perspective on RBI to cut at this point in time. I think the backdrop of a strong US dollar means that we are seeing continuous intervention in the FX market. And that intervention basically means that there is an impact on domestic liquidity. And in that backdrop, and the fact that our inflation is still somewhat higher, we are not seeing as much disinflation in the vegetable prices as was expected. Next year's view on inflation is also of close to 4.5%. I don't see a very real case for a policy rate cut in the February meeting at this point in time. However, there is some conversation about the fact that the growth has slowed down, and there has not been as much of a pickup in the second half as was expected. So there are some arguments from the growth side, but I think at this point in time, Reserve Bank can also potentially wait and watch for some more time before taking that step. In any case, the elbow room to cut rates at this point in time doesn't seem to be very, very large. I mean, if you expect the inflation to settle down at 4, then our overnight rate cannot be, significantly lower than 6%. We need to have at least 200 basis points of gap there.
No, exactly. And if the US Fed also is only going for 2 more rate cuts, then they are stabilizing at around 4. The inflation differential between the 2 countries is at least 200 basis points.
That's right.
If it is 4.5, so interest rate differential also cannot be less than 200 basis points. One would assume. Right. Okay, so you're betting on a non-rate cut.
Sorry, on that point, Latha, if you just allow me, if the total leeway that we have at this point in time is 50 basis points, I think the Reserve Bank should potentially keep that for a later date to see how the growth plays out. For example, if the growth weakens significantly from here onwards, then that's the time to use that tool.
Okay. Point taken. But how have you interpreted the liquidity easing measures? Some said that the liquidity has been eased so that when the rate cut comes, it will be passed on. Basically, your takeaways on the liquidity as well as this argument.
Yeah, so I think in the current context of where we are, liquidity is a far more important variable than rates, in my opinion. I think if we need to really be focused on the fact that liquidity in the system is well managed, the banking system is seeing a significant deficit of approximately 3 lakh crores at this point in time, which Reserve Bank has been supplying on a daily basis. But it is having some impact on, for example, the CD market rates, the bulk deposit rates, etc. So we do need longer-term structural liquidity in the system, durable liquidity in the system. What Reserve Bank has done so far is supplied 1.5 lakh crore. That durable liquidity is also being made available over a somewhat elongated time frame. I think it goes all the way up to February end. I think we need more liquidity and more durable liquidity in this quarter than what Reserve Bank has so far supplied. I think my guess is that between 2 to 2.5 lakh crores is the amount of liquidity that we will require in this quarter on a durable basis for markets to settle down and not have too much of pressure.
Okay, I'm being warned this is my last question, so I'm going to pack 3 questions. 1, do you expect a CRR cut? 2, what's your dollar-rupee range, say, for the next 6 months, and the yield range?
I don't expect a CRR cut anytime soon. I think Reserve Bank will try and manage the liquidity situation using the other tools like OMOs and buy-sell swaps and VRRs. CRR cut is a more blunt and more longer-term tool, so they would probably want to keep it for a later date if required. I do expect dollar-rupee to weaken, but I don't expect it to weaken too much. I think there is the volatility is being managed. There is active intervention from Reserve Bank, so I think 87, 87.5, provided dollar continues to be fairly strong. I think there is some argument for the yields to drip down a little bit more from here. So my range for yields will be somewhere between 6.5 to 6.75 for this quarter.
Oh, thank you so much for packing in so much in so short a time. Neeraj, Gambhir, I'll take a rain check from you to speak with you after the budget numbers are out, which anyway people believe is not going to be terribly bond market moving, especially if the fiscal deficit is going down to 4.5%. Thank you very much for this conversation. We wrap up on Bazaar on that note. Chartbusters coming up.